We're starting our discussion of profitability ratios looking at two ratios that include the term margin. And to help us remember all of these ratios, remember when we talked about turnover, generally we were talking about things being sold in sales. When we use the term margin, margin is typically going to refer to net sales or sales revenue. When we use the term return, we're going to see some ratios that have the word return in it. We're going to generally be speaking about net income. So margin, sales or revenue, and return, think net income. Let's start with our gross profit margin. Gross profit margin is equal to your gross profit in the numerator divided by the margin. We're talking about net sales or net sales revenue. Remember, gross profit is equal to sales revenue or net sales minus cost of goods sold. So we can think of our gross profit margin as sales minus cost of goods sold divided by sales. This ratio is going to tell us about the company's ability to mark up its goods above cost. We make that markup too high, customers will go to our competitors instead of us. But if we have it, our markup is too low, we're not going to be profitable. We still, after our gross profit, we still have to cover our operating costs. So we're trying to find that narrow area. We can say for every dollar of sales, the gross profit margin, it tells us what remains as gross profit. So for every dollar in sales revenue, how much remains after the cost of those sales? The cost of making or buying those goods. All right, so let's look at our numbers for Walmart and Costco and see which one has a better gross profit margin. Walmart's gross profit, we have 642, sales 642,637, cost of goods sold 490,142, and sales 642,637. We have, this works out to be 24%. So for every dollar of sales revenue, once Walmart covers the cost of those goods that were purchased, 24 cents remains. For Costco, we have 242,290 for sales revenue. Cost of goods sold 212,586, and net sales 242,290. And this works out to be 13%. So significantly lower. Costco has a significantly lower markup above cost when it's determining the sales price. So of course, gross margin higher is always better, and Walmart wins for this ratio. After the gross profit, the company still needs to pay its operating expenses, then also has non-operating items, those non-operating revenues and gains, non-operating expenses and losses, and it also has income tax expense. At the end, we can analyze its profit margin after all expenses, not just cost of goods sold, have been considered. Net income divided by net sales. And when we, earlier I mentioned that when we have net income, sometimes we use the term return. Sometimes we see profit margin being called return on sales. That's a nice way to call this ratio, because return tells us what goes in the numerator, the sales tells us what goes into the denominator. And sometimes you might see the term net profit margin. They all mean the same thing. For every dollar in sales, how much remains as net income? And let's look at the dollar amounts for Walmart and Costco. So if Walmart can continue to be efficient with its operating expenses and non-operating expenses and income tax expense, Walmart will continue to have a higher profit margin. All right, Walmart's net income 15,511 divided by its net sales 642,637. This works out to be 2.4%. And Costco net income 6,292, sales 242,290. This works out to be 2.6%. So very, very close. Not surprising that income is a very small portion for these companies. These companies are known to have very low prices, try to keep costs low, to have lower than maybe some other industries' profit margins. What we should see is that their turnovers are higher than most industries, and that's how they are able to stay in business. So they are close, but Costco comes out slightly ahead with a slightly higher profit margin.